If you're looking for a reverse mortgage and you live in California, then you've got to watch this video. Bottom line, reverse mortgages in California have some really unique characteristics that make them really advantageous to you as a senior homeowner to take. So in a second, I'm going to take you to this video, kind of a longer PowerPoint where I go over really deep into, this isn't going to be fluff, it isn't going to be 30,000 foot level, this is going to be deep, granular information on how reverse mortgages work specifically in California. My name's Jason, I run Reverse Mortgage Reality, and in 3 seconds, we're gonna go straight to the presentation. So 3, 2, 1, see you on the inside. So in this short presentation, I'm going to give you everything you need to know about California-specific reverse mortgages. And California is a really special state. I've done some really neat stuff with it, with reverses for folks in California. And just so you know, this isn't going to be like a 30,000 foot overview with a bunch of sales jargon. We're going to go deep into this. So at the end of this this little presentation, you're going to know exactly how reverse mortgage can work for you in California and what some of the neat stuff that kind of sets California apart. And I'll tease it a little bit. Right now in Cali, you can get a reverse mortgage at a younger age with way fewer fees. And there's even a program where we pay all of your property charges, meaning your property taxes and homeowners insurance. So what you're going to learn today, there's a few things here. So the first thing is how California seniors are using their home equity to create a retirement safety net. So in a nutshell, we're going to go into an example and show you how folks, even though the market's down, how they're using their home equity to save their retirement assets. It's pretty neat. And if you've been drawing down on your assets, you definitely want to take a look at that. Next, we're going to learn how young you can be in California to get a reverse mortgage, because hint, it isn't 62 anymore, right? If you're under 62, you'll be excited about that one. Third, we're going to go over a unique option that'll actually, I kind of teased it in the beginning, but a way that a reverse mortgage can pay your property taxes and homeowners insurance for life. And if you think about it, if you don't have to pay your mortgage, nor your property taxes, nor your homeowners insurance, when the reverse mortgage company is paying all that for you, your retirement income is going to stretch a heck of a lot longer. Almost finally, so next is I'm going to go into how you can have a reverse mortgage and still give your house to your kids. That's a big misconception out there. A lot of people think that the bank or the government owns the house. It's not true, but I'll explain exactly why. And at the very end, if you stay until the very end of this, and again, I'm going to try to make it as short as possible, we're going to show you how you can get a reverse mortgage. I'm saying with almost no fees, but I've actually helped a few folks, and 2 days ago we closed another reverse where there was actually all but about $125 of fees got reimbursed to the borrower. It's absolutely crazy. Nobody knows about it, but it's something that I'm doing on a weekly basis. So real quick, my name's Jason. I'm not going to go too deep into this, but I want you to know who I am. My name's Jason Eichmiller. I own Key Home Lending and Reverse Mortgage Reality. This is my family. This is Bridget, Alyssa, Jason, and Molly. And my contact information is here. It's 888-309-9705, or you can email me or go to my website, reversequotes.com. If you need to write it down, just go ahead and pause this video. In fact, pause it at any time. But I've been doing reverses since 2008, and I adore my clients, and I love the changes that this little tool has made for folks. And when they get a reverse mortgage, normally your retirement it improves just drastically. So as a guy who has 3 kids and I try to teach them to do the right thing by people, it's really awesome to be able to again use a reverse mortgage as a tool, because it is just a tool, but use it to help people so drastically. So I've got a couple reviews up here. One's from Jerry, one's from Nadine. Again, if you want to read them, you can go ahead and hit pause on this little presentation here. This is actually Jerry on top here. That's me and her kind of talking through how the reverse mortgage worked for her. On the bottom left is Maureen and I. She reached out to me. She's too young to get a reverse, but her mom wasn't. Her mom needed some help, so we helped her. And Maureen, as an attorney, she was so happy about how this worked for her. This is Catherine, who was just ecstatic about getting a reverse mortgage on her. She's a widow, and she had some expenses, so she needed a little bit of help, and the reverse did it for her. Then we've got Jim from a CPA firm. He's one of the partners there. I readily, as much as possible, I'll go in and educate attorneys, CPAs, financial advisors on really how these reverse mortgages work and how they don't work. And then finally, here's the website. So if you do go to reversequotes.com, if you want to book a time to talk, just go here and then you'll fill out your information on the right. On the bottom of the of this page, you'll see a bunch of the videos, that kind of video interviews I have with folks who have gotten reverses. But yeah, you just put your information in and excuse me, you click submit, and then I'll get the info and we'll schedule a time to chat about you and your situation. So now let's get into, what do they say, the meat and potatoes. What is a reverse mortgage? This is going to be high level because if you're on this video, you've probably looked at other stuff and you have a fair idea of what a reverse mortgage is. But basically, a reverse mortgage is a tool. It's just a tool, and it's just like a regular mortgage. The only real difference between a regular mortgage and a reverse is with the regular, you're forced into making payments month after month after month, forever and ever, amen, or at least for 30 years, maybe 15 years. But with the reverse, you can choose to make payments if you want, and you don't have to make payments if you don't want. So what we do with the reverse is we're always going to pay off anything that's owed on title. So we pay off your mortgage, your home equity line, any liens on title. And then after that, you get some tax-free cash. And the money that you get, I'm not a CPA, so you always want to check with your tax advisor. But I've worked with enough of them to understand that since you're borrowing your money, you don't pay taxes on the funds that you get. They are very, very heavily regulated by HUD and the FHA to keep them safe and secure. And you as the senior, or if you're looking at this, watching this for your parents, it's important to know that your parents, or you as a senior, you keep the home, you stay on the deed. The reverse is just a lien on the title. And if you sell the house, whatever you owe gets paid back from the sale and you get the rest. And if you live in the house for the rest of your life, the house goes to whoever you will it to, your heirs. Normally it's your kids. They get it, and they'll either refinance it if they want to keep it, and they just refinance what's owed, or if they want to sell it because they don't want it, they've got their own house, their own families, and they just want to make a couple bucks off the house. They'll sell the house, whatever's owed gets paid back through the sale, and they get the rest. Now, it's important to note that all reverse mortgages are what's called non-recourse, which basically means if the economy crashes, you know how right now, this is middle to late of 2022, the investment market has absolutely crashed, but the housing market is strong. If the housing market collapses and if you end up owing more than the house is worth, then you don't have to do anything. Nobody can tell you to leave your house. It's still your house. And the worst case scenario of all worst case scenarios is your kids get the house, more is owed on it than it's worth, and your kids say, I don't want it. They wash their hands of it. And the non-recourse aspect of it means that they don't have to pay anything. That means the estate doesn't pay anything, life insurance, the kids' assets, whatever you pass down. The reverse mortgage company can just take the house and sell it, and they've got to take the loss. So hopefully that makes sense. Now, a little bit deeper on reverses, kind of the ways to use them. They are absolutely godsends. And you think I might be exaggerating a little bit, but I'm not. These reverse mortgages change lives. And again, it's so neat to be kind of on the delivery side of these, where I know when I work with somebody, I know their life is going to improve. And then once they're done and they're closed, once they have the money in their pocket or they're not making a mortgage payment and they know that their retirement is secure, just the weight that lifts off their shoulders when I speak with them, you can feel the energy over the phone. It's just absolutely amazing to experience. So you can use a reverse to either stay in your home, or you can use them to buy your home. There's actually a reverse mortgage for purchase, which is really neat. Do a couple of them every month or so. Some ways that folks use reverse mortgages are to eliminate their mortgage payment, fund a business, pay for home health care, because nobody wants to go to the nursing home, help the grandkids. And what we're really going to stress here is how we're going to use a reverse mortgage to preserve your retirement assets. And that's absolutely huge in today's market, when home values are so high and when retirement accounts are so low. So let's talk about Dee for a second. Dee is one of my clients. She's a 67-year-old widow, lives in Oceanside, and her husband James, he didn't have life insurance. So Dee, when James passed, Dee was kind of up a creek. She loved where she lived, but she was having to take, was it $3,473 from her investments every single month to keep on going. Now her home, she had a pretty valuable home, $2.1 million, and she owed $569 on it. But again, with her mortgage expenses, with her living expenses, with her property taxes, homeowners insurance, all that stuff, she was having to draw this over $3,000 from her investments. And it was tough because this was what's called qualified money, which means she was paying taxes on the money that she was drawing down. So she needed to get rid of her mortgage payment, and she needed the cash to reimburse the kind of her funds. Just keep it in savings so that she would feel more comfortable in retirement. So could we help Dee? Of course we could. I wouldn't have her as an example if we couldn't. So we got Dee a reverse mortgage, which paid off her $569,000 mortgage and saved her $3,167 a month. So that's a drastic monthly savings, especially when you're on fixed income. But that wasn't it. What did they say? But wait, there's more. We also gave Dee $314,975 in tax-free cash to save, and she used a portion of it to put back into her investments. And that was something we kind of powwowed with her financial advisor. It's like, what do? You want to keep a decent amount of it in a very safe and secure account where there's no downside. So she kept a lot in a cash vehicle, but then she also did she did invest a little bit back into the market, which I think with the market as low as it is right now is kind of a smart play. And more importantly, her financial advisor thought it was a smart play. So bottom line of Dee's story is that she's financially stable. Her financial advisor ran the numbers. She's going to be fine for the rest of her life. And when we talk about kind of what reverse mortgages do psychologically for folks, Dee's sleeping well at night. That weight that was on her shoulders, it's lifted. And it's just the neatest thing for me to experience, to be the one person who just use this tool, because the reverse it's nothing too fancy, it's just a tool. But we use this tool to keep Dee's retirement comfortable and keep Dee's retirement stable. So I'm very thankful for her, and it was awesome that she allowed me to help, because it's like chicken soup for the financial soul. So now let's go down this rabbit hole a little bit and talk about home values versus investments. And it's kind of a yin-yang, because again, you understand, especially with your real estate, and if you do have an investment portfolio, you know that in today's weird economy, home values are very, very high and investments are extremely low. So we know a couple things. Number one, home values have skyrocketed in these past few years. And the home is either your biggest asset or one of your biggest assets. But it's the fact that you, as a senior, you've got more equity today than ever before. And just look at a couple of examples. Look at Los Angeles and look at Santa Clara County. LA, home prices in the past year, they increased almost 14%. Santa Clara, they've increased almost 17%. Now, I'm talking to you in September 2022. So the prices they've evened off a little bit. Maybe they've dropped maybe a tiny bit. So we might kind of be at a peak, but the equity that you've gained in the past couple of years it's probably more equity than you ever imagined that you would have. So house values have increased, but at the same time, and you know this if you have an investment account, you probably look at it every day and cringe a little bit, but our investments are getting slaughtered. So from January to June, the S&P has dropped 14%. If you're in growth stocks, you've gotten demolished. And then if you think about what do you do? If you take your assets while they're down, they've got less room to grow. So the asset drops, you take it, then if it's qualified money just means money that's taxed, it will absolutely decimate your retirement account. It's no bueno, not a good thing. So we actually have a chart here. If you look at if you retire, and this is just luck whether you retire at the beginning of an up market or a down market, you can't really control that. But look at an investment. The blue is the up market, the green-ish is the down market. But if you started at $100,000 and you withdraw $5,000 every single year, and your average return is the exact same. It's 4% on one side, 4% on the other side. If it's an up market, if you look at kind of the right of the blue column, you see that you have positive returns in the beginning. If it's an up market, look at this. After 15 years taking $5,000, even in the end of it, if it's dropping a lot, you still have $105,000 left. But if you retire at the beginning of a down market, so in a down market, let's say you lose 5% the first year, 6% the second year, 15%, geez, kind of like this year, and then the market recovers drastically, even though your average return is 4%, you only have $35,000 left after 15 years. So when you retire and when you take your money is a big deal, and I don't think anybody can argue that we're in a down market right now. So when you're taking whether it's just your RMDs, you kind of don't have control over that. You got to take your RMDs. But if you have to take more money, then when the market's dropping, your investments are dropping, and you're drawing your money, and you get taxed on top of it, it's kind of like a triple whammy. It's definitely no good. So what we want to do is and this isn't just me as the reverse mortgage guy, but also CPAs and financial advisors. They're really recommending using your home equity to safely take your home equity instead of taking your assets that have been reduced in a down market. So bottom line of all this is using your home equity when the market is down instead of using your retirement funds. It's just math. Your retirement savings is going to last a lot longer. So it's a big reason why reverse mortgages are so incredibly popular when home values are high and when retirement accounts are low. So I love this stuff, but that might have been a little bit dry. So if you want to take a break, stretch out, be like my guy Homer right there who's drooling over himself because he had a donut or two. So next, can you get a reverse mortgage if you're under 62? So if you're over 62, don't sweat it. This is going to be like a 2-second slide. But if you're under 62, listen up. You're going to be happy. So 2 types of reverses, which we're going to go over later. But you have the HECM, which is the government reverse. Then you have the proprietary / jumbo, which is outside of the FHA. So HECMs are still 62, although you can use a younger non-borrowing spouse. So if you're 62 and your wife or husband is 55, or 35 or 45, whatever it is, you can do it. But the age for the proprietary jumbo reverse mortgage is now, drum roll please, 55. How about that? Don't know if you knew that, but if you are between 55, if you're 55 or older, you can do a reverse mortgage now. And a lot of folks are doing the proprietaries for a few reasons that we'll go over later in the presentation. So, hope that if you're under 62, probably some good news for you. Now, let's learn how a reverse mortgage can pay your property taxes and your homeowners insurance for your entire lifetime expectancy. And this is California specific, so you can do it in some other states, but California, I feel like I end up doing it a lot more than any other states, just because of the way that the taxes are kind of structured. But it is absolutely amazing because if we use a reverse to pay off your mortgage or you don't have a mortgage payment, then the reverse sets up a side fund to pay your property taxes and pay your homeowner's insurance. You've got a pretty good deal there. You're not paying anything for property charges. So let's talk about Mel and Leo. 2 of my, they're so salt of the earth. They're like 2 of my favorite clients of all time, and I've been doing this since 2008, so I've had a lot of clients. So Mel and Leo, they're in their 80s and they live in Somar. And Leo's had a tough, he's the most positive guy. Both of them are so positive, but Leo's had a tough go. He has cancer and he had a mortgage and property charges, credit cards, all that stuff. And he was having a really tough time because he was on fixed income. He was trying to figure out, what am I going to spend my money on? Well, you gotta pay for your cancer meds, right? There's no way around that. And you gotta pay your mortgage and you gotta pay your property taxes. So he wasn't able to pay all together, though. He definitely, him and Mel, wonderful, wonderful people, but they needed help. So their home was valued at $770 and they owed $362 on it. So let's see what happened. So we actually got Mel and Leo a traditional reverse mortgage, a HECM. The reason why is they're older, and so when you're in your 80s, the HECMs normally trend to give you a little bit more money, but when you're younger, the proprietary reverses give more. So it's always important when you're looking at these to compare and contrast everything and let the numbers and let the math tell you what to do and honestly what not to do also. So we got them a HECM just to max out their cash, and the HECM paid their mortgage off, gave them $80,000, $80,121 for their retirement safety net. But wait, there's more. That's not it. We also, on top of that 80, we also set up a side fund. And the side fund pays property taxes and homeowners insurance for the rest of their lives. Incredible. No mortgage payment, no taxes, no insurance. You don't have to pay any of that. Plus they got some money for their bank account. And most importantly, I love this guy. They're so awesome. Such amazing people. Leo can now afford his cancer meds. Incredible. Makes me so happy to have helped them. So anyway, if you just kind of interlude real quick, if you've gone through this and you do want to reach out, and then put pause on the put this on pause, and you can either call me, you can email me, or you can always just go to the website and enter your information and pick a time to chat. So now let's talk about one of the myths. Big myth about reverse mortgages. I can get some money and then the government or the bank's going to take my house and the kids aren't going to get anything. Fortunately, it is not true, and I'm going to explain why. You might have heard people say it's not true, but you probably haven't been explained. So, details. A reverse mortgage is just a mortgage. It's just a lien on your home, just like a traditional mortgage or like a home equity loan. Remember, the only thing that's really different between this thing, well, I don't know, setting up an account to pay your property taxes and your homeowner's insurance is pretty unique. But the only main difference between a reverse and a traditional mortgage is that instead of being forced to pay the interest every single month, you choose if you want to pay the interest or not. So with a reverse, you still have full ownership of your home. You can sell it, pay it back, or refinance it at any time. And when you pass away, the house will go to your heirs. First of all, if you're married, I should say this. If you're married, if you have a wife or a husband, if you pass, then your wife or husband is fine. They'll get the house and nothing changes, because we will always do a reverse with them on the deed, or worst case, if they're underage and it's a HECM, they'll be a non-borrowing spouse, but they'll actually be okay. So as long as they live in the house, they'll be fine. Nobody could take it. So hope you understand that. Now, when you do pass away, your house goes to your kids. Again, whatever is owed, which is the money we gave you plus the interest, it gets paid back, and your kids get the rest. And again, there is special protection. If too much is owed, it's called non-recourse. So we can't ever go after the estate or your kids or any money. Can't ever do anything but grab that house back and the lender will sell it. But in the end, the kids, that's the worst case scenario again. If the housing market absolutely collapses, your kids don't get anything out of the house. Worst case, but nobody will take a penny from them. So now, remember I said wait till the end and we'll talk about the fees, and nobody on YouTube talks about reverse mortgage fees. I've seen it, I've watched everybody's presentation, and I'm thinking, like, how can I add more value? And it's almost like you're at a disadvantage when you call up looking for a reverse mortgage, because you don't know the rules and you don't know the fees. Well, forget that. I'm going to teach you all about the reverse mortgage fees right now. And it's an industry secret until they tell you what they are. And you're like, wait a minute, is this fair? Is this right or is it not right? So let's go into these fees. Won't take too long, but I think this is probably going to be one of the most valuable parts of this video that you get to watch. So the reverse mortgage fees are program specific. You've got the proprietary reverse, which is the jumbo. It's for kind of bigger home amounts, versus the HECM. And they have different fees that correspond. So follow this. And again, if you have any questions, feel free to reach out to me. Or if you want to comment below with your question, then I'll do my best to answer it. So first of all, we'll talk about the proprietary jumbo reverse mortgage. Jumbos, again, are for higher value homes. Now, there is no mortgage insurance ever charged on a proprietary reverse mortgage. So we'll talk about it with a HECM, but mortgage insurance on a HECM is 2% of your home's value. So if you have a $1 million home or $970,000 home value, then if you did the proprietary, you're saving $19,000 by not being charged mortgage insurance. Then 90% of the time, we're not charging origination fees either. The only time they can possibly come into play is if it's a line of credit jumbo and you're taking very little money. Then there's probably going to be some sort of an origination fee, but I've got a little control over that, so I can sharply discount the origination fee. So just keep that in the back of your head if you want to do a proprietary line of credit. But really, 90% of the time you're saving $6,000. So that's $25,000 that you're saving. Ho-hum, just a little bit of cash back in your pocket there. Let's talk a little bit more about the third-party fees. That's title insurance, title fees, recording charges. So occasionally, third-party fees are charged, but we normally, about 95% of the time, I've got a way to credit most of those third-party fees. And if we think about it, if I can credit the fees to you, the only thing is you don't get a reimbursement back on your counseling, which is normally $125 to $150, and then the California recording charges, which are about $300, get charged. We will even, this is crazy, actually closed a loan two nights ago where we did this. We even refund your appraisal fee. So you will shell out for the appraisal up front, but then when you close, we'll refund it. So pretty neat. Just get charged nothing to do this. And just so you know, protection, because there's no mortgage insurance, some people ask, well, does it still protect my heirs and my spouse? It does. So the proprietary reverse is by law, and this is a law, it's non-recourse. So it gives you the same protection as the regular old reverse mortgage. So that's the proprietary reverse. Normally, no fees at all with it, or very little, a couple $100 in fees, that's it. Now let's talk about the HECM. This is the traditional reverse where there still are fees. So there's three parts of the fees. There's FHA mortgage insurance, which is 2% of the home's value. Again, up to $970,800. That's the maximum loan size of a HECM. And if that's confusing, I don't want to spend too much time on it, but if that's confusing, go ahead, drop me a line or write a comment below and ask a question, and I'll absolutely answer it for you. So you have mortgage insurance, goes to the FHA. You have an origination fee. It's set by the FHA to be $2,500 to $6,000. Sometimes we can play with that depending on like loan size. And then third-party fees. You have title, recording, the appraisal, counseling. But the only out-of-pocket fees, and this is really important because you see that you're like, man, I can't. I'm doing a reverse mortgage to get money. I can't pay these fees. So the only out-of-pocket fees with a HECM, or heck with a proprietary also, is the appraisal and counseling. Everything else rolls into the loan. So I hope that makes sense. Now, here's when we're using a HECM. We're going to use a HECM if there's an older senior. So again, folks in their 80s, we're going to absolutely compare it. If it's a lower value home, so if the house is under $600,000 or so, normally HECMs do a little bit better. And also, if there's a line of credit. Now, the HECM line of credit, I'm not going to go into too much in this video. I'll do another one if you want. If you want me to do a video about the HECM line of credit, just go ahead and write it in the comments below. And if I get enough of you doing it, requesting it, then I'll do a video on the line of credit. But the HECM line of credit is really neat, and it's unique to the HECM. The proprietary doesn't really work the same way. But the HECM line of credit grows tax-free every single year forever. Forever. So you could be 62, get the HECM line of credit, live to be 95, and that thing is growing till you're 95, till you pass away. You take the money, whatever's owed, whatever you take gets charged interest. The money that stays in the HECM line of credit is not charged any interest, which is pretty neat. HECMs do require mortgage insurance, like I showed you in the slide before, and the third-party fees do have to be charged to you. So there's no way of getting it out of it. So now you're probably thinking, like, whoa, what should I do? Should I get a HECM or should I get a proprietary reverse? Well, a couple questions you need to ask yourself. And again, this isn't all-encompassing, but this will get you kind of down the right thought process. And then when you speak with me or anybody like me, at least I do a lot of discovery. I need to know, kind of what your goals are, what you have going on, how much you owe, what you're drawing down. I need to know everything. So the more information that I have, the better I can recommend which direction to go in. I hope this makes sense. So how much money do you need? If you need a lot of money and your home is worth over $600,000, then it's probably going to be the proprietary. Although again, you can look at both options. If you need the funds all up front, then you're going to go proprietary. And on the other hand, if you need a line of credit or monthly income, normally the HECM works better. However, I've done a few proprietary line of credit options before. It depends. Normally it's like if your house is worth over about 1.2 or 1.3, then the proprietary line of credit comes into play. So again, we will figure that out when we speak, and I'll kind of ask you the right questions to try to guide you to the right answers, and we'll compare and contrast everything. So again, if you want to go deeper into that, into the line of credit, or if you have specific questions, then go ahead and you can reach out to me, or you can just comment below. So hopefully that helps in kind of directing you in which way to go. Now, finally, I told you this is going way longer than I expected, but again, this isn't just some fluffy overview. I wanted to go deep into reverse mortgages in California so that you know exactly how this program will work for you. So here's the bottom line, really. Your home value has increased drastically over the past few years. But so have your expenses. We haven't really even spoken about that, but inflation is absolutely crazy. So your expenses have increased, and your investments, if you have money in assets and investments, your investments I don't know if I'm being too dramatic by saying fallen off the cliff, but they've taken a beating. And when you're on fixed income, it's really, really hard when all of your expenses are going up. I mean, go to the gas station, right? Go to the grocery store. Look at the price of materials. Go to Home Depot. It's absolutely crazy. So this is dramatic, right? It's in red and underlined, so it must be important. But no, taking too much of your savings or your investments too fast in a down market is an absolute disaster. I mean, remember that, go back to that chart that we shared. When you start drawing down on your assets in a down market, how quick, and again, we call it a term called sequence of return risk, but how quick do your retirement assets deplete when that happens? It's scary. And if you have that weight on your shoulders, I understand and I feel it. And a lot of folks that I work with have that same weight, and then we do the reverse, and we're able to preserve we're able to preserve the money in their retirement accounts so it'll last longer, and so that they can safely sleep at night. So that's really that's what this does. It's going to allow you to live a retirement that you deserve. It's going to allow you to thrive in retirement, and that's my goal for every single person that I speak with. Let's use your home, use what you got, and let's give you the best retirement that you can possibly have. So one more testimonial before before my contact information, but this is Teresa. She's a widow. She was very nervous. Talk about weight on her shoulders. It was like a boulder. she's having a real tough time, but did a reverse mortgage for her, and she's absolutely happy. I'm not going to go through this whole thing, but again, if you want, you can pause it and read it. She's an absolute sweetheart. So anyway, if you'd like to learn how this will work, especially for you, again, the California reverse mortgage it's special. It's a little bit different than the other states. So if you want to learn how it'll work specifically for you, you can contact me. My info is below. Directly, you can get me at 888-309-9705. Or you can email me, jason@keyhomelending.com, or go ahead and visit the website, reversequotes.com. There you'll put your information in and we'll pick a time to chat. But if you do need help, if you feel, if this presentation resonated with you and you feel like you need a little bit of financial help to navigate your way through retirement, if you have a lot more equity in your house than you did a few years ago, but your expenses are and the drop in your investments and your savings is kind of keeping you up at night, this reverse mortgage, again, I say godsend, and it sounds dramatic, but it is. It absolutely is a godsend. So I'd be honored. I'd do my very best to help you, to educate you, and to walk you through this kind of hand in hand. So thank you so much for your attention. I know this went a little long, but again, I wanted to be very, very thorough so you understood everything that's going on, all the ways that reverses work in California. So take care of yourself, and if you'd like to chat, let me know, and I'll do my very best to help you. Take care.